first tell us why, let's start off with why the Fed thought it could keep inflation lower than it has.
Well, so the Fed is meeting next week, which makes the inflation numbers that we got out late last week really important. There's a mystery that they're trying to figure out at the Fed, which is why hasn't inflation fallen more? When the unemployment rate shot up after the Great Recession, a lot of people were thinking that we were facing deflation and that at least the rate of inflation would be a lot lower than it is. As you just said, 2.7% is kind of not anywhere near a low rate of inflation. So that has the potential to hold them back if they, in this debate about whether they should do more to spur their recovery. They don't want to cause more inflation.
Hey, John, you've written a lot about it, and people talked about, I'll give them the name, the core three, like the Yankees have the core four of Bernanke and Yellen and Dudley here in New York, who have talked about, the idea that there's a lot of slack in the economy, and therefore, if needed, obviously, if needed, that the Fed could ease again or take another series of maneuvers. But you noted, and I've read it as well, that the Federal Reserve Bank of Minneapolis president, Mr. Lakota, had a very interesting notion where he was talking about that maybe there isn't much slack left in the economy. He noted the inflation being above the sort of medium-term target. And you talked about somehow that during the recession, it was, I think if I've got it right, that there was some, destruction of the part of the productive capacity of the economy. What do you make of all that?
Well, he's in the minority at the Fed, but he's making an argument that people are listening to. This idea of destruction of productive capacity. Connor Doherty and I have a very good example of this, I think, in our story on Saturday about the lack of slack in the economy. Look at the housing market. There's all of these empty houses on the market, but there are these structural shifts going on in the housing sector right now where people are moving from being owners to renters for a variety of reasons, in part because people can't get credit or they're being foreclosed upon. Well, in the ownership market, there's immense amounts of unoccupied home on the markets, and there's still downward pressure on prices. But in the rental market, where people are actually going, there's actually a dearth of supply in many markets.
Right.
And we're seeing rental prices going up. So what Coach Lakota is talking about is structural shifts in the economy that make the supply of goods and services in a variety of different sectors not quite as easy as the doves at the Fed, like Janet Yellen and Bill Dudley, think there is. There's not a consensus at the Fed about what's driving this, and it's yet another reason why they're really in a wait-and-see mode. They want to see how unemployment plays out in the next few months. They want to see how inflation plays out before they make any decisions about what they're going to do next.